All right, let's get straight to our next guest. Lee Cooperman is a billionaire investor and chairman and CEO of the Omega Family Office. Lee, you have been on with us for quite a while. I know you weren't supporting Donald Trump. I also know that you've been looking at the markets for a long time as a reluctant player in the markets. You were there, but you don't have great long-term implications for what you think might be happening. This morning, the equity markets, at least, are up pretty sharply, 1,300 points now for the Dow. What do you think with the Trump administration coming in? What does that mean for the markets?
Well, I think, let's face it, price-earnings ratios are a function of a bunch of things: growth rates, interest rates, and confidence. And I expect under Trump we'll have more growth, higher interest rates, and clearly the market has more confidence. And that's what's being reflected this morning. And, I was not in favor of Trump. I was not in favor of, Kamala Harris either. I basically felt that we needed an adult in the room, and we didn't have an adult in the room. We still don't, in my opinion. So I would think that the market is reflecting a degree of optimism that may be uncalled for. But we'll see. I'm not short any stocks, which is a good thing. I am short the S&P above 6,400, and I don't think we get there. And I think the market is down next year, if I had to guess. But it's just a guess. We have guns and butter, and I think guns and butter are going to lead to crowding out. Now, whether he could do enough to reverse the trends, we'll have to wait and see. He does have a mandate. And I think you have to say that a country that elects Donald Trump is a country that's very unhappy. And, literally half the country is with him, half the country is against him. He didn't win by a major majority, but he's in control, and let's see what he does. I'm rooting for him.
Doesn't sound like it.
Well, I'm not negative on him. I'm negative.
We don't have an adult in half the very unhappy country, and it is what it is, I guess, Lee. We could be happy for a couple of hours anyway today.
You think the country's happy, Joe?
I think the country spoke in a pretty overwhelming fashion.
Because of how unhappy they are, though.
Well, the popular vote, too. I think that there's a lot. I think there's a popular vote of people that are happy. Yeah, Lee, I do.
Yeah, but I think that there's half the nation is unhappy, half the nation's happy.
It's gonna be either way.
Well, I understand that.
Will Rogers' comment was, if politicians did 10% of what they promised, there would be no need for heaven. So Trump is promising a lot. We hope he could deliver. I don't know. At the end of the day, the market's 22 times earnings, and given what's going on in the world, the Middle East, and given what's going on domestically, and given our fiscal situation, I would think the market is very fully priced.
You did. Oh, go ahead.
None of the models work. The market is expensive against interest rates, yet it's up a lot, and interest rates are up this morning.
That's what I was going to point out. The higher yields that you're watching at this point, the 10 years at 4.44, so that's a 14 basis point move from where we were yesterday at this point. Not traumatic, but it definitely shows you where the bond market initially thinks things might be headed. And that may be a question of inflation. It may be a question of the yield curve normalizing. That's what Gary Cohn has been telling us over the last several days. What do you think, Lee?
Well, I said this in the last time I was on the show. I thought the Fed would cut short rates, but long rates would move up. And I think the Fed will cut again, and long rates will move up. We're nowhere near, prior to 2008, the 10-year government bond yielded in line with nominal GDP. So if you have real growth of, as I say, 2.5 or 3%, and inflation of 2.5 or 3%, the 10-year yield wouldn't be excessive at almost 5 or 6%. And the market does not allow for that in terms of its pricing. So, I'm not a trader, and I'm not short anything, but my inclination would be to sell stocks on strength. I don't think the market.
You said you are short north of 6,400, above 6,400 for the S&P, and obviously we're not there. This morning, you got another 500 points to go to get to that. You didn't think we'd be there. So you're short above 6,400 of the S&P. Are you short anything when it comes to bets in the Treasury market?
No, I'm not. I retired in 2018, and I'm trying to keep my life simple. I have some health issues that basically slows me down. But no, I don't play the game as well as or as actively as I could and did in the past. But I would say my general view is bonds are short and stocks are fully valued and will more likely go down than up from here. And that if one was a trader, the sell strength of the opening, and that the market will be down next year. But I'm not making any big judgments at the current time. Clearly, there's a big wave of confidence. And, when you think about the confidence, just think about it. 20 former members of his administration said he was unfit to be president. Tariff stuff, that's crazy. Think about it. Tariffs are basically a relief for labor. You're basically making companies to increase production domestically, which increases demand for labor. If you're going to limit immigration and you're going to throw a lot of people out of the country, that's going to push up inflation. So, when you're betting on
if the tariffs are negotiating tactics, which is what we've heard from some people on his campaign, I guess we will see. But if the tariffs are a negotiating tool.
You heard the same thing about Kamala. I'm old-fashioned. I listen to what people say, not what they do. And basically, the idea that Kamala is not going to do anything to tax the rich, even though she spoke about that aggressively, and the fact that Trump is going to not do tariffs, you're relying on people doing the opposite of what they said they're going to do. And that's a risky proposition.